Sales predictions with transformers leverage advanced machine learning models to analyze complex patterns in sales data. These models excel at capturing sequence dependencies and can outperform traditional methods like ARIMA in predictive accuracy. A study by Google showed that transformer-based models improved sales prediction accuracy by up to 15% over conventional methods. Time series decomposition is a technique used to break down sales data into its component parts to better understand underlying patterns. It involves separating the data into trend, seasonal, and residual components, allowing analysts to model each aspect individually. This method is particularly useful for identifying hidden trends that can inform strategic business decisions. Trend analysis focuses on identifying long-term patterns in sales data, which can indicate sustained growth or decline. This analysis is crucial for strategic planning, as it helps businesses anticipate future sales trajectories. For example, a retailer might adjust their inventory stock based on a detected upward trend in holiday season sales. Seasonality detection in time series involves spotting recurring cycles that occur at regular intervals within sales data. These cycles are often driven by predictable factors like holidays or weather changes, which can significantly impact sales volumes. By accurately identifying these patterns, businesses can optimize promotional strategies to capitalize on predictable demand spikes. Residuals analysis examines the random fluctuations in sales data that cannot be attributed to trend or seasonality components. This analysis helps in assessing the effectiveness of a model by understanding the noise that remains after other patterns have been accounted for. By studying residuals, businesses can identify unexplained anomalies that may indicate errors or opportunities for further investigation. Additive model in time series decomposition involves summing individual components like trend, seasonal, and residuals to model the overall data structure. This approach is particularly effective when the magnitude of seasonal changes is constant over time, making it easier to interpret patterns. An example is quarterly sales forecasting, where each quarter's trend and seasonality are combined to predict future sales figures. The multiplicative model is used in time series analysis by multiplying components such as trend, seasonal, and irregular variations to represent the data. This model is suited for datasets where seasonal variations change proportionally with the level of the series, commonly seen in economic indicators. One practical application is retail sales forecasting, where seasonal factors like holiday sales vary with changing economic conditions. Stationarity and differencing are fundamental to ensuring that time series data maintains statistical consistency over time, which is crucial for accurate predictions. Stationary data exhibit constant mean and variance, allowing models like ARIMA to perform effectively without bias. Techniques like differencing help transform non-stationary data into a stationary format, which is essential for leveraging transformer models in sales prediction. First differencing is a technique applied to time series data to stabilize variance and mean, crucial for accurate forecasting. By subtracting the previous observation from the current one, first differencing helps in removing trends and making the data stationary. This method is often used in financial markets, where daily stock prices are differenced to reveal underlying patterns. Seasonal differencing addresses periodic patterns in time series data by subtracting observations separated by a seasonal period. This technique is vital for datasets with strong seasonal components that might obscure the true trend and cyclic behaviors. In practice, it's used to adjust sales data for annual cycles, such as removing yearly seasonal effects to better understand long-term trends. Stationary transformation is a crucial process in time series analysis, aiming to ensure statistical consistency by converting a non-stationary series into a stationary one. This transformation allows models to perform optimally, aligning data with assumptions of constant mean and variance over time. For example, the augmented Dickey-Fuller test is commonly used to verify stationarity after such transformations. Lag features and autocorrelation are essential tools for capturing temporal dependencies in sales data, significantly enhancing predictive models. By analyzing the correlation between current and past sales, these methods can identify patterns in cycles that are crucial for precise forecasting. The use of lag features, combined with an autocorrelation function, helps in building robust models that understand the historical context of sales data. Lagged sales involve using past sales data as input features to inform future predictions, providing context and continuity. This approach helps capture the temporal dynamics of sales patterns, making predictions more accurate. For instance, a model might use the sales figures from the previous month to predict the upcoming month's sales with greater accuracy. The autocorrelation function ACF measures the degree of correlation between a time series and its lag versions, revealing significant patterns. A high autocorrelation at certain lags indicates strong dependencies over those periods, which can be critical for accurate forecasting. ACF is often visualized using correlograms to help analysts interpret the strength and decay of these correlations. Temporal context in time series analysis refers to incorporating influential time-based factors to enhance prediction accuracy. By considering elements like holidays, promotions, or economic conditions, models can predict sales with more precision. A well-known application is adjusting sales forecasts around Black Friday, where sales spikes are anticipated due to the temporal context. The Fourier transform for seasonality is utilized in sales predictions to model periodic patterns by transforming time series data into frequency components. This allows for the identification and extraction of seasonal cycles within sales data, as it converts temporal information into signals that can be analyzed. A practical application is seen in retail sales analysis, where the Fourier transform helps in detecting and forecasting recurring patterns like weekly or monthly sales spikes. Sign terms are integral in the Fourier transform for representing cyclic behaviors within a time series, capturing the essence of periodic fluctuations. These terms are characterized by their oscillatory nature, which is mathematically expressed as sine waves, enabling precise modeling of underlying cycles. An example of their application is in seasonal sales forecasts, where sign terms help in predicting peak sales periods corresponding to regular events. Cosine terms complement sine terms in the Fourier transform by expressing cycles with a different phase shift, crucial for capturing complete periodic patterns. These terms are particularly useful in modeling phase-aligned cycles that might not be effectively represented by sine terms alone. An instance of their utility is in economic time series, where cosine terms assist in detecting subtle shifts in sales cycles that align with fiscal quarters. Fourier inputs are explicitly incorporated into time series models to enhance the prediction accuracy by adding frequency-based features. By integrating these inputs, models can account for seasonality more effectively, leading to improved forecasts of sales trends. A notable example is in e-commerce platforms, where Fourier inputs are used to anticipate fluctuations in consumer demand based on past shopping patterns. The sliding window or rolling statistics technique is pivotal in encoding localized trends within time series data, offering insights into short-term variations. By applying a moving window across the data, this method enables the calculation of dynamic metrics such as rolling mean or variance, capturing the evolving nature of sales. Businesses often employ this approach to monitor real-time sales performance, adjusting strategies based on the latest trends. Rolling mean involves calculating the average of data points over a specified window, which helps smooth out fluctuations in sales data. By applying this technique, businesses can better understand underlying trends without being misled by temporary spikes or dips. For example, calculating a 30-day rolling mean can reveal consistent demand patterns in monthly sales cycles. Rolling variance measures the variability of sales data within a specified window, providing insights into changes in volatility over time. This metric is essential for understanding how much sales figures deviate from the average, helping businesses gauge stability. By tracking rolling variance, companies can identify periods of increased risk or opportunity, such as during promotional campaigns. Localized trend analysis captures short-term changes in sales data by focusing on specific time intervals. This approach helps businesses respond swiftly to emerging patterns that might influence sales strategies and inventory management. For instance, a localized trend could reveal an unexpected surge in demand for a product, prompting timely stock adjustments. Time embeddings in transformer models are used to recognize temporal aspects of sales data by incorporating time-related features. These embeddings allow models to better understand the sequence in which events occur, enhancing prediction accuracy. For example, time embeddings can differentiate between weekday and weekend sales patterns, leading to more nuanced forecasting. Positional encoding employs sinusoidal patterns to integrate time information into transformer models, effectively capturing the order of data points. This method ensures that the model comprehends the temporal sequence of sales data, which is crucial for accurate predictions. By using positional encoding, transformers can maintain a sense of timing, such as distinguishing between quarterly sales periods. Learnable time embeddings are a crucial component in transformer models, allowing them to adapt to specific events in sales data. These embeddings are trained to recognize and encode temporal patterns, improving the model's ability to forecast sales during events like Black Friday. By integrating learnable time embeddings, models can achieve greater precision in predicting sales fluctuations linked to time-specific occurrences. Temporal inputs serve to enhance model input by incorporating time-related data that aids in capturing the temporal dynamics of sales. This inclusion allows transformer models to better understand how time influences sales patterns, such as recognizing peaks during weekends or holidays. By leveraging temporal inputs, models can produce more accurate forecasts by accounting for the timing of sales events. Cross-validation in time series is essential for maintaining the reliability of transformer models in sales predictions. It involves techniques like time-based splits and preserving causality to ensure that models do not learn from future data, which could skew results. By implementing robust cross-validation strategies, businesses can trust in the accuracy of their sales forecasts, even in evolving market conditions. Time-based splits utilize a forward-chaining method where training and test sets are created based on temporal order. This approach ensures that models are evaluated on future data that was unseen during training, mimicking real-world forecasting scenarios. Time-based splits are particularly useful in sales predictions, as they help maintain causal relationships and improve the model's ability to generalize. Preserve causality is a critical principle in cross-validation, aiming to avoid future leaks that could compromise the integrity of sales predictions. By ensuring that models only learn from past data, this strategy prevents the inadvertent training on information from the future. Preserving causality safeguards the validity of predictions,